Everybody, this is Kevin Gormley, a CPA that does financial planning with Leading Edge Financial Planning, and today I wanted to talk about the high income versus high wealth. And everybody knows what rich is, okay? Well, at least we think we know what rich is. Rich is a person or people that have a bunch of money, okay? Well, the issue with high income is that just because you have a high income doesn't mean you're rich. And the focus on this video is to try to get yourself from high income to become high net worth. And so I call it going from quadrant 1 to quadrant 2. As you can see on this diagram here, when you're in quadrant 1, that means you have a very high income. So you have money flowing in. You're in a good position. I mean, you're making a lot of money. The issue with high income, though, is that you'll pay a lot of taxes many times. As Warren Buffett has said that he pays a lower tax rate than his secretary. He said that a number of years ago, but it's probably still true today. The tax rate that he actually pays, the effective tax rate, is lower than a secretary. Now, how could that be? Well, it's because different types of income have different types of taxation. And that's really the focus of the interrelationship between financial planning, taxes, and investing with the high income team is to try to fix some of these issues that high income people deal with. So the mission again is to get from quadrant 1, which is high income, low net worth or low wealth, to high income with a high net worth or high wealth, so you can just walk away at any time. That's really the focus. And the focus is this income that's coming in from work or from your career or from your job, whatever you want to call it. There's not a lot we can do with this income. It's really building a future income stream that's taxed at a much better rate, the Warren Buffett rate, if you will. So the first issue that you have to deal with many times if you're making a high income and your income is growing is lifestyle inflation. Okay, I call it the high income paradox because the more money you make, the more money you spend. So the first mission is to try to figure out a way to trick yourself when income is increasing that you can continue to save the same percentage or maybe even more of a percentage. Let's say it's 10 to 20% of your income is being saved as you get raises. You continue to save more and more money. And the only way to do that is, I call it tricking yourself, and we all need to be tricked with this, is when you get a raise, save half of it, and maybe you spend half. Or when you get a raise, save it all. So that's really the issue. The second issue is that the taxes in your present income that are coming from work are going to be taxed at a higher rate. So taxes are the biggest expense, if you will, when you're when you're earning money from work. So if you can shift money over through either deferring money into 401ks or investing somehow into Roths, you can do the backdoor method. There's also another method, which I'll link to a video at the end here, where if you're working for a company and you can put after-tax contributions, and then building a taxable account, which is really what Warren Buffett has. I mean, everyone talks about getting wealthy using tax-deferred 401ks and IRAs, but the way Warren Buffett pays lower taxes is he sets up his financial situation not to get income W-2 from work. It's more coming from the capital gains on investments that he has. So getting more money over into this more advantageous area. So again, that's taxable accounts, that's Roth IRAs, maybe even Roth 401ks. And with tax rates at generational lows right now, even people that might make $200,000 a year may consider using Roth 401ks at work. So, but it's all about the present tax rate, but setting your life up so your future tax rates will be lower, will be more like Warren Buffett. So the third thing is that future taxes can be controlled much greater, and you have to look at the dynamics of how much money do you have that's tax deferred, because when you get to 70 and a half, if you need the money or not, you're going to be getting required minimum distributions, and these are taxed in the same way as the income that you get from work. So setting up your financial lives, I like to call it your financial affairs, in a way that you can minimize tax each and every year is really the main focus. So trick yourself. That is, when you automatically get raises, always have a plan before you get the raise. Always put things on automatic pilot. That's something that we really try to help our clients do, is when you're going to get that raise, already have decided beforehand that you're going to raise the amount of money you're putting into one of the 3 types of accounts. Taxes, think about current taxation and future taxation. Now, we don't know what's going to happen with future taxation, but again, if you have money in different types of accounts, you're really diversified from a tax perspective. And then the third thing is setting up your future system when you get to retirement and you're going to be drawing out of all these accounts to do it in a way that makes a lot of sense. Have your assets, your investments, that is, your assets in the right buckets so you can minimize taxation and use more of the money that you've worked so hard to earn. So thanks so much for watching. There's going to be more on how to do these 3 things in this series on the high income investor. So thanks so much for watching again. Have a great day.